nerdsy term called output gap, which is about slack in the economy, which creates disinflation pressure. And that's actually what's in the data. And it is remarkable post-COVID environment that we're in right now when you consider that over the past 4 quarters, real GDP growth in the United States has been 3%. Think about that. That's pretty good. That's aggregate demand. GDP is all about spending. We had 3% GDP growth, yet the unemployment rate has gone up 80 basis points. The industry-wide capacity utilization rate, which is the unemployment rate for the business sector, that's come down by 120 basis points. And core inflation has come down 150 basis points, all in the context of 3% growth in aggregate demand. And the only way that that can happen is if aggregate supply is expanding faster than aggregate demand. Basically, what's happening with labor force participation combined with productivity. And when you back out that data as an economist, it's telling us that the supply side of the economy is expanding at 4.7%. And that's why a lot of people think that we're in a recession, or what they call a vibe session, because you've got growth on the supply side running so far above the demand side. And now, by the way, the demand side is no longer a 3% growth economy. It's now closer to 2%. So that disinflationary output gap is actually widening. That puts downward pressure on inflation. It'll put downward pressure on corporate profits, although not priced into the stock market just yet. And it is going to put ongoingly upward pressure on the unemployment rate. And at some point, the dam is going to break. And so people say, well, it's been a benevolent rise in the unemployment rate, 3.4% at the low to 4.3. There's been no job carnage. However, the unemployment rate is still an important barometer because it tells you how the supply and demand curves are moving in the most important market in the economy, which is the labor market. And as the unemployment rate goes up, what happens is that with a lag, nominal wage growth goes down. And ultimately, the dam breaks and wage growth goes down enough that people curtail spending. Now, right now, all you're seeing it in the data and you're seeing it amongst the retailers, that consumers haven't really pulled back in entirety, but a lot of frugality is going on, right? A lot of shift toward no-name products, a lot of trading down. You're hearing about Lamborghinis and Jaguars and BMW convertibles being parked outside the Walmart. Walmart's saying how it's grabbing market share among high-income individuals. Well, you see, people are becoming more discerning in their spending patterns, value-conscious, bargain hunting, and that happens traditionally before the actual retrenchment in consumer spending. So we're in that fog right now, that transition, because even though you've had this run up on the labor market in the unemployment rate with a 3% growth rate, think about that, 3% growth, unemployment rate up 80 basis points in the past year. So what happens when we start to see growth slow down to 2% or 1%? And the next thing is a 5 handle on the unemployment rate, in which case, by the way, at that point, the consensus will move from soft landing to recession, and the Fed's probably going to be cutting rates a lot more aggressively. And admittedly, that might be more next year's story, but that is still going to be something that will be making the headlines at some point over the next 6 to 12 months. 3% GDP growth in the past year, and the unemployment rate's gone up significantly. So, yes, you've not had job carnage, but more people are coming into the labor force. What does the unemployment rate tell you when it's going up? Is that people are coming into the labor force, but they're not finding a job. Okay, that's the problem, is that more than 90% of the people coming into the labor force, and frankly, I don't really care if they're immigrants or whether they're native born. 90% of the people who come into the labor force looking for a job have not found one in the past year. This time last year, 90% of the people coming into the labor force were finding a job. Now 90% of the people coming into the labor force are not finding a job. Well, what does that mean? When more people are competing for your job, more people, and you're looking over your shoulder, I haven't lost my job, but there's 4 people in line for my job. Are you going to go to your boss and say, give me a pay hike, please? I don't think so. So what the rising unemployment rate does for the existing people who are working is it creates a certain level of insecurity. Maybe that's not the worst thing in the world. It's called competition. The rising unemployment rate is telling you that there's more competition for jobs, which means that wage growth is going to slow. You're going to be a little more circumspect to go ask for a pay increase over the course of the next, say, 1 to 2 years, by virtue of the fact that there are more people looking for a job and they're lining up for your job. Okay, so that's the significance So when people say, you try and paint the lipstick on a pig, fine. Yeah, there's been no net job loss. Absolutely. And you still had this run up in the unemployment rate. The unemployment rate by itself is significant because of the implications for a very important price in the economy, which is wages. That's the importance. Half the growth in non-farm payrolls in the past year has come from the birth-death model, which is an algorithm. Half the growth has not come from the actual head count, okay? It's come from the birth-death model, and that's why non-farm payrolls are a lagging indicator. But the one thing that I'm focusing on that's telling me that we're going to start to see net job loss, I can't predict the exact month, is because I'm watching the hiring rate. The hiring rate is going down like a hot knife through butter. The hiring rate is going down. It's lower than it was before the pandemic. The hiring rate is going down. And the only reason we have not seen net employment loss is because the firing rate has remained so low. So companies to this day are still hoarding labor because of the horrible memory of what happened in 2020, 2021, into 2022, when because of COVID and the lockdowns, and then of course the government paying people not to work much longer and people were making more money, but the labor demand supply mismatch and the difficulty companies had finding labor is a bitter and lasting memory for a lot of companies. So they're like the little boy with the finger in the dike, right? And so they've been loath to lay people off for fear that when it comes to the next cycle of hiring, I won't find them again. What they've been doing, of course, is furloughing workers to part-time. All the employment has been part-time work in the past year, okay? There's been no full-time jobs being created. And we know looking at the work week that, and it's consistent, that companies have been cutting the hours. They haven't been cutting the bodies. So the firing rate has remained low, but the question is at what point will the firing rate start to rise? And at what point does the hiring rate and the firing rate cross over? And that's critical because that's the month that will print a negative headline on employment. And either people will say, well, it's just a one-off. It's just one data point. A lot of people will start figuring out that this recession, which had been delayed, never was derailed. But that's really the key. The only reason why employment's not gone down outright is because the firing rate has remained incredibly low. The question people have to answer is, will it remain low over the next 3, 6, and 12 months? Because the only thing we know with certainty is that the hiring rate, the proxy for labor demand, is falling precipitously. And I don't think that's going to be changing anytime soon. If Donald Trump becomes president and he undergoes those really draconian tariff increases, and we run the numbers on these, inflation would come back very temporarily. And in fact, we could see inflation get as high as 6% under his policies. But it'll go there and stay there as long as 9% did, like for a month, and then come back down because tariffs are a one-time price level adjustment. It's not really a sustainable source of inflation. But yeah, will we get an inflation shock under Trump's policies? Most likely. And there'll be some other offsets, right? His deregulation policies will cut costs. And that will actually transcend the tariff increase, which is, like I said, a one-time shift. It's not a sustainable source of inflation, but it will cause a temporary inflation shock, 100%. What tax cuts do to companies is it fattens their margins and allows companies to either cut prices or hold prices steady. For a temporary period of time, the tariffs will win out. And so I would say that we go from, say, 2 to 3% inflation under Trump to, say, 6. And so people will say, well, didn't you just say inflation's gonna not go up? Well, I said barring a shock. So if he does the tariffs, that's a shock. And so we go up to 6, and by the end of his term, we're probably right back down below 2. And under Kamala Harris, all I can say is that her policy plank is going to raise taxes by $5 trillion over the next decade. So I look at hers as being far, despite what she's going to do with, a baby bonus and tax credits, so on and so forth for lower middle income households, her overall policy is one of a tightening of fiscal policy. And you can talk about people making $400,000 a year, but a lot of people make a lot more than that contribute a lot to the economy. They're going to be facing a much higher tax bill. Plus, I think the real kicker is her proposal to boost corporate tax rates from 21% to 28%. Yeah. That, I think, is actually going to generate the conditions for a capex-led recession. I think that it will not be inflationary in the sense that what companies are going to be cutting back on labor and cutting back on spending. So it's going to be a depressant on aggregate demand. We actually ran the numbers, and it's going to create the conditions for higher unemployment and a weaker economy. If you look at the whole thing, it's a very populist policy. It redistributes income to the areas of the population that are very supportive of the Democratic Party. But when we run the numbers, overall, her policies will probably be more deflationary through the demand contraction. People haven't factored that in, what it's going to mean for the wealth effect on spending from capital gains taxes. People aren't talking about that. People aren't talking about the actual increase in the corporate tax rate. And there's other taxes. And then, of course, we're just looking at the fact that there's going to be income orientation to lower income households. And you got to factor that in. And that's going to be good for them. But, people at the low end basically spend money on necessities for the most part. They're not out buying iPhones and going on vacations to Disney. When you run all these numbers out, Trump is more inflationary near term, but it's a price shock that will subside, and its other policies are disinflationary on the supply side. Kamala's policies will be more disinflationary on the demand side. So either way, it's even hard for me to build a sustained inflation view out of fiscal policy for the foreseeable future, except for the fact that I will have to write and keep writing if Trump wins on the tariffs to chill. He put in tariffs, back in his last presidency, and it was a one-time shift. And inflation actually started his presidency at 2%, and everybody went hyper on inflation, and inflation finished at 2% in his presidency. So go figure. Inflation is a very complex variable. When we run all these fiscal policy measures, and we've done them on both planks, inflation only goes up under Trump for a short period of time and it comes right back down again. But if you're taking a look over the whole term, inflation under both policy planks ends up lower then than it does today. And that's really the fundamental point. I think the Fed is more important because the stock market by nature is a long duration asset. And so as the Fed cuts and cuts and cuts and takes interest rates down, then those future earnings, the future cash flows that get discounted to the present value become more valuable. So the Fed is infinitely more important than fiscal policy when it comes to earnings.